Hi, I'm Barry Norris, the manager of the Argonaut Absolute Return Fund, and I'm here to talk to you about the fund, the strategy, and how it might fit into your investment portfolio.
What is the aim of the fund?
So the fund is aimed at investors who want to diversify their equity market exposure for a return profile which is very different from the other equity investments that they hold. So we assume and indeed encourage our unit holders to have other equity investments, whether those be active funds or cheap passive funds or indeed individual stocks. But the key point about our fund is that we complement these existing investments. So in building an overall wealth management portfolio, uncorrelated returns are incredibly valuable. I think the best example of this was in March 2020, where the market fell 19%, but we managed to deliver a positive return of plus 15%.
Can you tell me about the track record of the fund?
So since launch, the fund has returned 131% inclusive of all fees, with almost zero correlation to the market. We're particularly pleased with the way the fund has performed in negative market months. So since launch, there have been 57 months where the market has delivered a negative return, and we've managed to deliver a positive returns in 33 of these, an overall positive return in negative months of 25% compared to minus 85% for the market in those months. And so we don't aim to be negatively correlated, we aim to be uncorrelated. And I think we can see that also in our best months, where the fund has delivered 80% in our best 10 months versus the market in those months just 10%. And in the worst 10 months for the market, where the market fell 77%, the fund has delivered plus 18%. So low correlation is the aim. That means that the direction of the fund shouldn't be predetermined by the direction of the market.
And where does the fund invest?
So the fund is a relatively simple single stock equity long short strategy. We invest in equity markets predominantly in Europe and the US. All of our positions are in single stocks, those that we like in the long book and those that we don't like in the short book.
And how does the fund differ from other absolute return funds?
So I think the absolute return sector as a whole is full of a lot of funds targeting low volatility, which also means they're targeting low returns. We're different in that we target low correlation. And that means that our returns can potentially be higher, but we also think that low correlation is much more valuable than low volatility. So I would say there are two drawbacks to low volatility funds. One, low volatility usually means low returns, which in turn means that fees will be disproportionately high. And in our view, low volatility offers no diversification benefits. So low volatility funds will go up and down at the same time as the market. They may go up and down less than the market, but they'll deliver their returns at exactly the same time as the market and therefore be highly correlated to them. So it's worth bearing in mind that an investor can always replicate this at any time just by holding the market mixed with cash. So we are different because we're targeting double-digit returns, and our uncorrelated return is much more valuable because it comes at a different time to the market and therefore most other funds, and also therefore cannot be easily replicated. We offer genuine diversification in a way in which, in our opinion, other alternative absolute return funds simply do not. And I think it's a very common mistake, even by professional investors, to overvalue low volatility and undervalue low correlation. So if you own 10 funds and 9 of them are essentially long-only funds that only deliver returns as the market goes up, your overall Sharpe ratio and your overall diversification will be improved, not by holding a low volatility fund, but by holding a low correlation fund.
And are there any drawbacks to running a low correlation strategy?
So because the fund is designed to deliver returns at different times in the market, the fund will mostly be an outlier in terms of monthly returns when you compare it to most other funds which don't seek to do that. And I think investors tend to be used to their funds going up and down at the same time as the market, maybe a bit more, maybe a bit less every month. So ironically, of course, the fact that we're an outlier is precisely why our returns are more valuable in terms of diversification. Cosmetically, of course, this can make our funds look more volatile than what they actually are, given that the risk is relative rather than absolute. So the positive attribute of low correlation inevitably gives the impression of higher relative volatility, when in fact the return profile brings down the overall volatility of the wealth management portfolio. So when blended with other funds that are more positive in market direction, we actually bring down overall volatility. Because we target low correlation rather than low volatility, it's also inevitable that the fund will have drawdowns, but these will typically happen at different times than drawdowns on the stock market. And like the stock market, which has drawdowns, we have always recovered from those drawdowns. In a bull market, it's probable but not inevitable that the fund may lag behind, because the insurance, if you like, of our short book, which acts as our market hedge, may be a handbrake on our overall returns. Conversely, in a bear market, investors often flee into cash when we might be making positive returns from our short book. So this can be frustrating. It can lead to investors forgetting the role of the fund in their overall portfolio and buying and selling it at the wrong time. So we would encourage all of our unit holders to look at the role of the fund in their overall portfolios and to take a long-term view.
And how does the fund achieve its low correlation?
So as with most funds, the fund runs a long portfolio of stocks we like that we hope will appreciate in price. However, what makes the return profile different is that the fund also runs a short portfolio of stocks that we don't like, which acts as our market hedge. So it's worth pointing out that at all times, our long portfolio is bigger than our short portfolio. As we don't want to be negatively correlated to the market, we want to be uncorrelated. And we found that this is really necessary for us to be net long, to be uncorrelated actually, rather than negatively correlated.
So what characteristics do you look for in your stock selection?
So whereas most fund managers will categorize themselves as either value or growth investors, we categorize our investment process as earning surprise. That means that we think that corporate earnings, particularly when companies deliver better or worse results than they're expected, drive share prices rather than the cheapness or the quality of the stock. So that should mean that the process is capable of delivering returns, double alpha, in different types of economic cycles, those led by growth stocks, which we've seen over the last decade, but also if we go back to a market which is led by value stocks, that should allow us the flexibility in our portfolio to deliver positive returns in different stock market cycles.
And what is your current view of the market?
So we're about to go into a period of very strong economic growth. Part of that is just a rebound from lockdowns and from COVID, but it's also due to really just the unprecedented stimulus that we're seeing at the moment. And since the great financial crisis, we've obviously had quantitative easing, zero interest rates, so we've had a lot more of that recently. But on top of that, we're now getting double-digit fiscal deficits, massive government spending, which is resulting in a significant industrial restock and quite a lot of inflationary pressures. So as a result of that, the average company can now grow earnings again. But I think that the valuation that the market gives those growth companies that have been able to deliver in anemic growth environments will actually go down. So higher earnings, lower valuation, that means to us that some of the cyclical areas of the market, if you like, will probably keep performing better, and those with high valuations, growth stocks which can't deliver for whatever reason on their valuation, will probably largely underperform.
And what industries are you particularly bullish on?
So we're particularly bullish at the moment about three industries. House building, both in the UK and the US. So it's worth remembering that housing starts in the US are around the same level as what they were in the 50s and 60s, despite the US population being twice as large. And we think that very low interest rates and the effects of lockdowns, which means that people have been wanting to de-urbanize or own their own home, will mean that that's going to be a really sustainable consumption boom over the next few years. We're also very bullish on semiconductors, and we thought, when we first went into lockdown, the semiconductors would do fantastically well as the economy accelerates its digitization. And I think now what we're seeing is significant bottlenecks in semiconductor supply. We don't think those bottlenecks are just short term. We think that they're also due to the fact that things like electric cars just need more and more semiconductor content, and that the industry just hasn't been geared up to supply this. So we think semiconductors is obviously the most cyclical area of technology, and at the moment cyclicality is good. Commodity semiconductors are good, and we also think that it's an area of the market which should see further consolidation, and hopefully the companies that we're investing in will benefit from that. The third industry that we're really bullish on at the moment is the steel industry, which is very much an old economy industry. It's really been starved of capital since the great financial crisis. And I think one of the things that is going on at the moment is China, which is the world's biggest steel producer, the world's biggest steel exporter, that has really set the price of global steel, has cut back on its exports and cut back on its production because it wants to cut back on pollution. And this, of course, is the massive swing factor in the global steel market, in that European and North American steel companies that had to worry about cheap Asian exports now have to worry less about that at a time where demand for steel is absolutely booming, whether in household products, construction, or cars. And part of that is cyclical, but we also think part of it is a secular change in the way that China's no longer the lowest cost producer in the steel market. And there are also opportunities with some of our companies that produce steel, which they call green steel, that doesn't have a carbon footprint. And we think if companies are prepared to pay more for that, then that turns these companies into growth companies rather than just being very cyclical. And the sorts of valuations at the moment that steel companies trade on are really quite amazing. Their dividend yields are typically well above the price earnings ratio. And we think these companies essentially can almost generate enough cash in a few years to, if they wanted to, buy back all of their shares.
What is your current biggest holding?
So our biggest holding is currently German company Volkswagen, which we hold directly and also indirectly through holding company Porsche. And until recently, the market thought that Tesla would be the only winner from electric vehicles, and Tesla would, if you like, have just this dominant market share in electric vehicles in the same way as Ford dominated mass car production in the 1920s. However, I think it's now clear that the market has underestimated the efforts of the likes of Volkswagen. Volkswagen will produce the same amount of electric vehicles as Tesla over the next 18 months, and is catching up fast in areas like automatic navigation and batteries, where perhaps it previously lagged Tesla. So whereas Tesla trades at a very speculative valuation, Volkswagen is one of the cheapest companies on the European stock market, and that's a valuation, if you like, that we think is frankly ridiculous. And in addition, Volkswagen owns luxury brands like Porsche, Lamborghini, Bentley, Ducati, which if spun off would, we think, attract the same type of multiples as an Italian car manufacturer Ferrari. So we think there's a lot of pent-up demand at the moment for cars. The industry is currently supply constrained because of shortages of components like semiconductors, and that should lead to positive earnings surprise. And we also think, though, that the market is going to be willing to pay a higher valuation for Volkswagen given its EV prospects. And we think that these will come to fruition sooner than most investors suspect.
Can you tell me about your short portfolio?
So the short portfolio is currently around 30 stocks with an average position size of just 1.5%. In our portfolio, there are three types of shorts that we look for. The first are frauds. Last year, the fund identified successfully 3 frauds, which went bust when the scale of the wrongdoing became apparent. Wirecard being the most infamous. And we have a few more that which we think might go the same way this year. So, it's certainly worth remembering that the stock market has its fair share of dishonest management who are trying to pull the wool over their investors' eyes. And we believe by holding these companies to account for poor governance and ensuring that the stock market doesn't fund criminals, we significantly punch above our weight in terms of moral purpose compared to more fashionable forms of ESG. And we help the stock market not only not allocate capital to wrongdoing, but also allocate capital to companies which actually are good for economic growth and also for savers. So the second aspect is overpriced growth. And I would say in a period where of higher economic growth, where we think in general valuations are going to come down, that we've allocated more to overpriced growth than in recent years. And we certainly see significant opportunities for companies that won't deliver on their valuations and on their promises, which have made them so highly valued from the stock market. And that can be, for a variety of different reasons. But if you like, when booms turn to busts, those tend to be good short opportunities. And just finally, value traps. So these are stocks that the business model simply doesn't work anymore, and they're being, if you like, disrupted by other factors. I would say, that has worked particularly well over the last few years, but we've taken down our allocation to these types of short in order to allocate more to overpriced growth going forward.
And what are the risks that you're hedging the fund against, and are these changing?
Good question. So I think for most of the last decade, we've been worried about a deflationary bust. So what we mean by that is essentially very low economic growth and a recession. And because of a lack of economic growth, borrowers, whether companies or individuals default on their debt because they can't pay it back. And that could be a company, that could be individuals, that could be a country. And that's been the biggest risk, if you like, to equity investors. After all, equity investors are the last in the line to get paid. Equity investors get what's left over after employees and debt holders have been paid. So I think the market now, in a higher growth environment, offers a different challenge, which is if we're moving into an era of higher economic growth and higher inflation, actually the risks are different. The risks are that booms turn to bust because there's too much capital allocated to them. And the risks also are that investors need to keep their pricing power and need to hedge against inflationary outcomes.
And why do you think the investors should look at the fund now?
Well, aside from needing to run diversified portfolios and needing uncorrelated assets, which will always be the case, it's worth remembering the markets have had incredibly good run over the last 12 months, where from the massive sell-off that we saw at COVID, the market has rebounded very strongly. So we certainly believe that funds that are less reliant on market direction should be able to prove their worth going forward, and we also believe that the Absolute Return Fund should be a good egg in anyone's investment basket.
So how could investors find out any more information about the fund?
So we have a website, argonautcapital.co.uk, where the usual marketing information like kids documents, products perspective, and fact sheets are available. We also have a regular blog, Argonautica, where usually every month we write something hopefully of interest. We're also on LinkedIn. We have a YouTube channel where you can watch some of our videos, and we're on Twitter. And if you want to deal in the fund, we're available on all good investment platforms.
Great, thank you very much.
Thank you.